Good day, students. I will be doing the review question 4.2 with you. It says Daniel Chu Ltd, a new business, will start production on the 1st of April, but sales will not start until the 1st of May. So now they are telling us that production, though it will start on the 1st of April, but the sales will not start until the 1st of May, meaning that production will take place in April, but sales will take place in the month of May, meaning now production on the month of April will be sold in the month of May. So now that's what it means. And the sales that we see here were produced in the previous month. The sales that you see in the month of May, which is the sales of 500, these sales units were produced, or these sales are the units that were produced in the month of April. Meaning now in June, when you see the amount of sales or expected sales in June, which is 600 units that are expected to be sold, these units were produced or manufactured in the month of May. So now meaning now the sales of the current month is the production of the previous month. The sales of the current month is the production of the previous month. So that's what in summary this says so far. It says planned sales for the next month. Planned sales for the next 9 months is as follows, or are as follows. So now we are given the sales for the next 9 months from the month of May until the month of January. Then we continue, and it says that the selling price of a unit will be consistent at 100 Rand per unit, and all sales will be made 1 month on credit. So now in other words, they are telling us that we sell to our customers on credit, and the customers will pay 1 month later. So now meaning cash of the sales of the current month will be collected in the following month from our debtors. That means the debtors collection period is 1 month after the month of sale. It is planned that sufficient finished goods inventories for each month's sales should be available at the end of the previous month. It is very important sentence again. It is planned that sufficient finished goods inventories for each month's sales should be available at the end of the previous month. So now it means closing inventory is equal to sales of the next month. This means closing is equal to sales of the next month. Closing inventory is equal to sales of next month. Closing inventory is equal to sales of next month. That's what this means. So now it means the closing inventory at the end of April, if you look in the first sentence where they said production will start in April, but sales will start on the 1st of May. So now in other words, the units that were produced in the month of April will become the closing inventory of April, which will be the sales of the month of May. That is why we see 500 as the sales in the month of May. These 500 units are the units that were produced in the month of April. So now if these units were produced in the month of April, therefore now they became closing inventory by the end of the month of April. And that closing inventory is equal to the sales of the next month. So now that's what the sentence says. Hence I'm saying closing inventory is equal to sales, is equal to sale of next month, or sales of the next month. So now we continue on that same note. I'll try to clarify everything in this question. Then it further says that raw material purchases will be such that there will be sufficient raw material inventories available at the end of each month precisely to meet the following month's planned production. So now in other words, they are telling us that when we purchase raw material, it should be such that by the end of the current month there is sufficient raw material purchased that will be equal to the planned production of the next month, should be equal to the planned production of the next month. It means, in other words, the purchase of the current month should be equal to the closing stock, and the closing stock will be equal to the planned production of the next month. However, I will explain that when we do the budgets. Therefore, now it says this planned policy will operate from the end of April, meaning starting in April, this policy will be applicable, where we make sure that purchases of raw material or the closing raw material at the end of the month, as they said, should be available at the end of the month, meaning the closing raw material at the end of the month should be equal to the planned production for the next month. Then now they say this policy will start on the 1st of April or start at the end of April, sorry. Purchases of raw materials will be on 1 month credit. In other words, they are telling us that all the raw material will be bought on credit, and the raw material purchased on credit will be paid 1 month later. That means we pay our suppliers 1 month after the month of purchase. Then after it says the cost of raw material is 40 Rand a unit. And take note that the 40 Rand is a unit, 40 Rand a unit. That means we don't need to know how many kgs are needed per unit. It is already per unit of a finished product. So now we'll multiply all the finished product by 40 Rand to get to the raw material cost in total. The direct labor cost, which is variable with the level of production. So now direct labor cost is variable and it varies with the level of production, is planned at 20 Rand a unit. That means you are also given direct labor cost per unit, not per hour. So now in this case, all we need is just to know the number of units that were produced in that period, and they say of finished production. So now that means if we know all the finished units or production number of units for that month, we multiply that by 20 to get to the total cost of direct labor. Then after it says production overheads are planned to be 20,000 Rand each month, and this includes 3,000 of the depreciation. Remember, when we do cash budget, because there's a question that requires us to do cash budget here. When we do cash budget, we don't take into account depreciation, or in fact, we have to remove depreciation, in other words. Why do we do so? It's because depreciation is a non-cash item, and we are only dealing with cash items or the inflow of cash and the outflow of cash when it comes to the cash budget. So now it means when we record the production overheads, we have to say 20,000 rands minus 3,000 rands. Then the production overheads for each month will be 17,000 rands until the end of the budget period. Non-production overheads are planned to be 11,000 a month, of which 1,000 will be depreciation. Once again, we have to do the same thing here, where we say 11,000 rands, we subtract depreciation of 1,000, because depreciation is a non-cash item. Then we record our non-production overheads as 10,000 for each month of the budget period. Then after it says various non-current assets, which were the fixed assets costing 250,000 rands, will be bought. So now this is 250,000 rands that is expected to flow out of the business during the month of April. And they say, except where specified, assume that all payments take place in the same month as the cost is incurred. In other words, now they are telling us that the entire 250,000 rands of the variable non-fixed cost will be paid in the same month it was incurred, meaning now this will be outflow of cash in the month of April. So now this will be the outflow of money in the month of April. That will be recorded as cash outflow in the cash budget. The next one says the business will raise 300,000 in cash, and they say in cash. So now this is cash flowing into the business. From what? From a share issue in April. So now there were shares that were issued, and the shares amounted to 300,000 rands. So now if these shares were issued and they amounted to 300,000 rands and it was cash issue of shares, it means this will be the inflow of cash through the issue of shares, and that will be recorded under, again, cash budget as inflow of cash. Then after, we are required now to draw up the following for 6 months and up to the end of September. Draw up the following for 6 months ending 30 of September. And it says under 4.2.1, we must draw up a finished inventory budget showing just physical quantities. So now we want to know in this budget how many units were left at the end of the period. We also need to know how much was the production, and also have to take into account the opening if there was the opening inventory. So now we are doing the finished inventory budget, where we have to calculate the closing inventory at the end of the period. 4.2.1 is the start of the question. So now we are doing 4.2.1 in this exercise. And this is the review exercise 4.2. Review exercise 4.2 is the one that we are doing, yes. Review question 4.2. So now let me start with the question name, review question 4.2. Review question 4.2. So now we are doing review question 4.2, where we start with 4.2.1. And starting in this question, we must start with the months, and this is for 6-month budget ending in September. So now if the budget is up to the end of the month of September, it means obviously it's starting April, May, June, July, August, September. So now we are starting in the month of April. Then we start with April, we record May, we also record the month of June, we record July, and we record August, and the last month will be September. Then we always start with the opening inventory. We say opening, then after the opening we say plus production. Then after production, we just leave one line. Then after, we say sales. Then after sales, that will give us the closing inventory. Then now we go and check if was there. Remember, there was no opening inventory on the beginning of April. The reason why there was no opening inventory beginning of April is because production for this company started on the 1st of April. So now it was the start of the production. So now there was no opening. It was just the beginning of everything. Then now we don't record anything under production, under opening. Then under production, now we have to record the units that were produced in the month of April. Now remember, production starts in April, but sales will not start until the 1st of May. So now, as I did explain this before, that the sales that you see in the month of May is the production of April. Because before you can sell, we first have to produce. Meaning now what we see here as sales are the units that were produced in the month of April. This is the production of April. In April, we had a production of 500 units. And all these units were sold in the month of May. So now that is why the sales of the next month is equal to production of the previous month. Sales is equal to production of the previous month. In other words, we can just say sales is equal to production of last month. So now it means the sales that we see is the production of the last month. That's what it simply means. So now let us record the production for April, which is the sales of May. Production will be 500. 600, 700, 800, 900, and 900. So now if we see all these amounts, they go in this order: 500, 600, 5, 6, 7, 8, 900, and 900. So now these are the production units as it is been stated. Then now we need to calculate the sales for, or record the sales for the month of April. Remember, in April there was no sales. They told us that. They said production will start in April, but sales will only start on the 1st of May. But sales will not start until the 1st of May. But production will start in April, but sales will not start until 1st of May. In other words, this tells us that there was no sales in April. Therefore, now production becomes closing, and therefore now closing for the month of April will be 500 units. Then after closing becomes opening of the next month. Therefore now the closing the closing of 500 becomes the opening of 500 in the next month of May. Therefore now we do have the sales now for the month of May. We already have the production and we have recorded the production. Therefore now we have to record the sales for each month. We have to record the sales for each month. So now the sales for the month of May, we are already given all the sales in the given information. Here are the sales: 500, 600, 500, 600, 700, 800, 900, and 900. These are the sales for the current month as it is given to us, which are the production of the previous months. So now our sales for the month of May, it is 500, 600 for June, 700 for July, 800 for August, and 900 for September. These are the sales that we have. So now let us record. Here we have 500, and in May we say 500 plus 600, it will give us 1100. These are the units available, but this is not important. Units available for sales. Units available for sales. These are the units that are available for sales. So now we have 1100 of the units that were available for sales in the case of May. Then you say 1100 less sales. Sales are always in brackets, because sales are reducing the units that were available for sales. Then 1100 less 600, this will give us an amount of 600 rands. And so 600 units. And 600 units is the closing. This is the closing at the end of May, and this closing becomes opening beginning of June. So now we record that 600 as the opening beginning of June. Therefore now we do the same thing in June. We say opening plus production. There is a plus here, there is a plus throughout, but you don't have to write the plus sign, please. So 600 plus 700 will give us 1300. And we say 1.3 less sales of 600, and this will give us 700 units. And this is the closing at the end of June. And closing becomes opening beginning of July. Remember, this is the opening. This is the opening. So now we record this as the opening of the next month. And the opening of the next month is July, therefore it will be 700. Then after we say 700 plus 800, and this will give us 1500 in the month of July, which is units available for sales. Then I will say less the units that were sold. These are the units that were available to be sold or available for sales. And we sold 700. So the remainder will be the closing inventory. And that remainder will be 800 units. And 800 now is the closing in the month of July, which becomes the opening or opening at the beginning of August. And we record that as 800 opening balance, which was the closing balance in the previous month of July. Then 800 plus 900 in August will give us 1,700. And 1.7 is the units that were available for sales once again, and we less the units that were sold, which is 800. And what will be left will be 900 units. Therefore, now this is the closing, and the closing becomes the opening of the next month once again. So now opening for September will be 900, and 900 plus 900 will give us 1,800. And 1.8, we subtract the units that were sold. Then this will give us 900 as the closing inventory in the month of September. So now we have completed this budget, and this was the finished inventory budget. Finished inventory budget. Though I forgot to write it, let me write it on here. Finished inventory budget. Finished inventory budget. So now this was the finished inventory budget that we just did now. So now the finished inventory budget is done. Then we do the next budget. And the next budget will be the question 4.2.2. So now we are doing the same 6-month budget, but now it is based on the next requirement. And the next budget is a raw materials inventory budget showing both the physical quantities and financial values. So now we are looking at the units and the cost of the raw material that will have by the end of the period, and the one that was purchased and the opening stock. So now we are doing the raw material budget. We are doing a raw material budget. Raw material budget. And in this raw material budget, remember guys, we are still doing it for the same 6 months. Nothing has changed. We are still taking into account for 6 months. So now we have the same months once again. We have the same months. Nothing has changed. The first month is the month of April. Second month is the month of May. Another month is June. Another month is July. Another month is August. Another month is September. So now these are the months that we have, and we always start with the opening. We always start with the opening. Then from the opening we say purchases in this case, because we are purchasing raw material here from the suppliers. Purchases. Then after, we will have material available for production. Then we will have the next point, and the next point will be production, where we take material and we send it for production, or in the production department. Then from production we will have closing inventory. Then after we'll have closing inventory. Then after closing inventory, this budget will be done. So now here we have to draw a line so that we separate. Then after we also have to draw a line here so that we separate the two. So now we have to start with the opening once again. Remember, there will be no opening once again, even in this case. Let us go and check how do we record when it comes to the raw material budget. In this budget, we have to take into account the fact that we are not given the number of kgs or the number of liters or the number of meters that are used to produce 1 unit. So now in other words, it means 1 kg or 1 unit, 1 liter, 1 meter is equal to 1 unit. So now we don't have to be multiplying by any kgs or meters or liters, meaning 1 unit is equal to 1 kgs if this product is using material of kgs, or its materials in kgs. So now everything will be using the units that are given here as the sales and the production units. So now let us begin with that, and we record based on the instructions. Second paragraph said to us, raw material purchases will be such that there will be sufficient raw material inventories available at the end of each month, precisely to meet the following month planned production. In other words, they are telling us that when we buy raw material, we have to make sure that the closing balance of the current month is equal to production of the next month. That's what it means. This says at the end of the month, such precisely to meet the following month's planned production. In other words, this means closing should be such that it is equal to production of next month. Production of next month. It should be such that closing raw material for the end of this month will be equal to production of the next month. So now that is the first simple approach. Therefore now we have to go and we record now. In this case we have to record first opening balance, and we said there's no opening balance. So now in the month of April, we have to record all the purchases. Now when it comes to purchases, remember we already know how many units to purchase. We already know our purchases. So we already know our production. We already know the production. So now in this case, we have to make sure that we buy enough units so that these units will be equal to, at the end of the month, will be equal to the next month planned production. And remember, production is the one that comes from the material budget. There we do have the production. This is the production line. So now in this case, remember we have how many units? We have 500 units in April and 600 units in the month of May. And in this case, we also don't have an opening balance. So now, in other words, whatever we record here as purchases, we have to make sure that after the production of 500, because production is 500, we have seen that production in the month of April is 500. We have to make sure that our purchases that we record here, after we deducted the production of 500 units, the remainder should be equal to the planned production for next month. And the planned production for next month, it is 600. So now, in other words, our purchases for the current month should be such that the closing raw material must be, in other words, 600. So we already know that closing must be 600 because that's what the statement said. It said it should be such that each and every end of the month, raw material purchases will be such that there will be sufficient raw materials inventories available at the end of the month. This sentence, at the end of the month, precisely to meet the following month planned production, meaning closing is equal to production of next month, as I simplified this to you. So now, in other words, we already know that closing is equal to next month production. So now, if we need to have 600 at the end of the month, then the question will be how much should be the purchases if there's no opening balance. Obviously, purchases should be 500 plus 600, which will be 1,100. So that after we deduct the production of 500, what is left is equal to the next month production, and the next month production being 600 units. So now I hope that is very clear, guys. I try to simplify it for you. So now, as I did make mention of my own statement here, and I said closing is equal to next month production. Closing is equal to next month production, or it's quite a production of next month. So now I can record all the closing throughout because I already know that closing must be equal to next month production. So now I know that production for the month of June is 700. So now the production for the month of June should be the closing of June. So now that 700 will be, of June will be the closing of the month of May, because we are in the month of May. This is the month of May. So now I check again, what is the closing for July? Closing for July will be the production of August. In July we have 800, and that 800 is the production of July, and the production of July will be the closing of June. So now in June we have 800 as the closing. And again, production of August is the closing of the previous month, which is July. Therefore now that will be 900 in July. Then again, production of September will be the closing of August, and that will be 900. Then we need to know the production of October. Production of October, we have to take that from our information. Production of October will be this 900. Production of October is this 900. Why? Because these are the sales units, remember. These are the sales units, and the units that we see here as sales are the units that were produced in the previous month. So now that is why I'm taking November, because the sales of November is the production of September. Sales of this month is equal to production of previous month. I did highlight that sales of this month, sales of this month is equal to production of last month. That's what this statement means. In other words, that's what the statement means. Sales of this month is equal to production, sales of this month is equal to production of next month. This is production. It's equal to production of last month. So now that is why I'm taking the sales of this month, and I take that to be the production of the previous month or last month. So now the sales that we see in November are the units that were produced in October. So now that means production of October was 900 units. So now in other words, if production of October is 900, therefore now closing of September will be 900. Will be 900 units. So now in September we also have 900 units as the closing. So now closing of May will be opening of June, and closing of April will be opening of May, and this closing will be opening of July. So now we record that closing will be opening of May. This will be 600. And 700 will be the opening of the month of June, and we record 700 as the opening. And here again, closing of June will be opening of July, then we record that as opening of July, and closing of July will be opening of August, then that will be August 900, and this will also be 900, because this is the closing of August becoming opening of September. Remember, this is the opening balance line, guys. We are under the opening balance. So now opening becomes the closing. Then now we continue in that same note. So now what we are looking at is production. What we are looking at now is purchases and production. So now let us check. Our purchases should be equal to production. Our purchases should be equal to production. So that is another strategy that you must attack this question with. Purchases is equal to production. Purchases is equal to production. Purchases is equal to production. So now in this case, we have to record our purchases for the month of May. And remember, it has to be such that at the end, we are left with 700 as the closing. So now, hence, I'm saying purchases is equal to production. So now, our purchases will be equal to production. And our production, where is it coming from? production comes from the materials, from the finished goods budget. So now here is the production. Here is the production that we are looking at. We are looking at this production which is in the finished inventory budget. Units that were produced and they were finished. Production was complete when it comes to these units. So now production comes from there. Then we say now production for the month of May was 600 units. So now production, I said purchases should be equal to production. So now I have to record here production for this month, production which is production of the month of May. Production of the month of May. Okay, sorry, purchases called production of next month. Sorry for that. Production of next month. Just complete that. Purchases is equal to production of next month. So now we have to say when we record our purchases in the raw material budget, we have to look at the production of the next month. We are in the month of May and production of the next month is how much? It is 700. So now it means our purchases will be equal to production of the next month, 700. This is only with exception to the 1st of April. Why this is the case is because in April there was no opening balance. Opening balance was 0. That is why now we had to take production of the current month and production of the next month, and that becomes the purchases of the current month. So that after we deduct the production of the current month, we are left with the closing, and the closing which is equal to the production of the next month. So now you see there we do have closing of 600, and the closing of 600 is exactly equal to the production of the next month, and production of the next month was 600 in the month of May. Remember, we are looking at the production, guys, in the finished goods budget. These two budgets, they go together. So now we cannot leave another one without taking into account another budget. So now we continue on that same note. So now we say, okay, in this case, our production is, our purchases is equal to production of next month. So now next month production is 700 there, which is in June, 700. That will be the purchases of the current month. Then after we have production of the month of July, that will have to be purchases of the month of June. And production of August will have to be the purchases of July. That will be 900. And production of September will be purchases of August. Then that will be 900. So now we need to know the production of October. And we already know that the production of October is 900. Then production of October will be purchases of September. So now we have recorded all that concerns the purchases. We recorded all that concerns the purchases. Why in this exercise have I decided to do what I'm doing? Where I'm saying now in this case, I have said that I've highlighted that purchases is equal to production of the next month. Why am I doing that? It's because there was a statement that said that. This statement is telling us to do exactly what I am doing, because this statement is saying that raw material purchases will be such that there will be sufficient raw material inventories available at the end of each month precisely to meet the following month's planned production. In other words, our closing inventory of raw material should be equal to production of the next month, and I did also make a note of that. So now closing will be equal to production of next month. So now how do we make sure that happens? Is to say, okay, we already have our purchases, we have recorded them. We have to take into account the fact that there was already opening balances that are given there. So now if we say purchases is equal to next month production, therefore now we'll say in this case in the month of May, we'll have to say 600 in the month of May plus 700. Then from there this will give us 1.3. So now 1300 will be the units that were available. Then after we'll say, okay, we have now to record, let me just record all these amounts throughout first. Then we have 700 plus 800, and this gives us 1.5, and 800 plus 900, that gives us 1.7, and this will be 1.8 and 1.8. So now these are the number of units that were available, units available for production, units or inventory available for production. Available for production, or material available for production, in other words. Material, inventory available for production. This is what was available for production for the month of May, June, July, August, September. Then now the question is, how much was produced? Then now let us record production. Remember, production is already recorded in the finished goods budget. Here is the production for each month, and there's nothing to worry. We just record the amounts as they are. So now we record 600, negative, 700, negative, 800, negative, 900, negative, and 900, negative. So now with that being recorded, the reason why I said that purchases is equal to production of the next month is because it has to be such that after we said opening plus purchases, we get to 1,300. And now we have to subtract production for this month. And production for this month is equal to opening. Remember, production of this month in terms of material is equal to the opening. So now if we deduct the opening or the production of this month, what is left is 700. And whatever is left here as 700, it has to be equal to the next month production. And our next month production, it is 700. There, the next month production is 700. And is that next month production equal to closing? Yes, the next month production, it is really equal to our closing, because our closing is 700 and our next month production, it is 700. And again, here we have the closing of 800, and the closing of 800, it has to be equal to the production of the next month. And here is the 800, and the 800 is equal to the production of the next month, which is the month of July. So now we are doing this because we are aware of the question and want to make sure that we answer the question as it's supposed to be. So now, with that being explained, that is why I said purchases is equal to production of the next month. And we have to be aware that at the end of the period, the closing in the raw material budget should be equal to production of the next month. We have to know that the closing of the raw material is equal to next month production. Let me write that again, although I did write on the other side. It said that closing is equal to production of next month. Closing is equal to production of next month. So now there is the closing that I have for the raw material budget, and it is equal to the production of next month. Then we look at the production of next month. Production of next month is in the material, in the finished goods budget. Production of next month is 600, and my closing is again 600. And closing of the month of May. Here the closing of the month of May. Is it equal to production of next month? Production of next month is June, which is 700 is production, and my closing is 700. And closing is again 800 in the month of June. then it means my production for July must be 800. Production for July must be 800. So now we are answering exactly. Therefore, now again, here is the closing of 900. My closing of 900 must be equal to production of the next month. And that 900 is for July. Therefore, August should be the production. There is August, and that is the production of August. Production, there is the month of August. And again, now, same thing, 900 is the closing of August. That should be the production of September. There is the production of September. So now, guys, what I'm doing is answering exactly the question, because it said that raw material purchases should be such that at the end of the period there is enough in units to cover the next month production or planned production. So now that's what that statement simply meant, and we've applied that exactly as it's supposed to be applied. So now let me continue on that same note. So now we have covered the two budgets, and now we have to go to the next budget. And the next budget is the raw material budget, which is in financial terms. Raw material budget in financial terms. And in this budget, there is nothing new that we are doing. Everything is been done already. We are just recording all the figures in financial terms. So now it will be raw material budget in financial terms. Let me count the columns and see if we'll have enough. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. Okay, there won't be enough space. Or let me record this in the next. Then we're doing raw material budget in financial terms. Raw material budget in financial terms, which is the value of this budget in rands. We start with the first month, and the first month is April. The next month is May. The next month is June. Next month is July. Next month is August. And the next one is September. We do the same thing. We have the opening. We have the purchases, because we purchase raw material from our suppliers. Then after, we draw a line to get to the material available for production. Then after, we have production. Then after, we have closing. Then now once again, this will be material available, or inventory, or material, however you call it, material available for production. Material available for production. Material available for production. That's not important, but I'm just highlighting it so that you know that is the material available for production. There will be no opening. And now what we do in this budget, we are just adding the value to the units. And how do we do that? We already know that the cost of raw material is 40 rand a unit of a finished product. So now that is the raw material that we will be dealing with. So now we are doing the same thing. We just multiply our units. Then after we multiply our units, that will give us the raw material in value. So now raw material in value, we multiply everything by 40. So in other words, we have to come to our raw material budget. And what do? We just say in each and every amount, we say times by 40, times by 40, times that by 40, times that by 40, we multiply that by 40, multiply that by 40, by 40. We multiply everything by 40 because that is 40 rands. So now our budget will be in financial terms. We do the same thing, guys, throughout. Very boring stuff, I know. Multiply by 40, multiply it by 40. So now that's what we do throughout because the material cost per unit was 40 rand. So now we multiply everything by 40, and let me just take this picture so that we don't struggle in terms of moving up and down. So now we go to the next page and we record, and there was no opening balance, remember. So now if there was no opening balance, then that means it will not be recorded. There won't be any opening balance. So now this is what we'll be doing in this exercise, where we multiply everything by 40. Therefore now we'll be saying, in this case, 1.1 times by 40. Then we do all these workings now. So we say 1.1 by 40, 1100 times by 40. This gives us 44,000, which is our purchases. Then we record that as 44,000. Then after we say, 500 times by 40 times by 40, that gives us 20,000. That gives us 20,000. Then that gives us 20,000, which is the production. And this is 44,000. Then at the end, it will give us the closing of 40. It will give us the closing of 24,000. The closing of 24,000. Then we do the same thing in the next month. We say 600 now. We say 600 times by 40. Multiply this by 40. 24,000. Then we have 24,000 here. And our production for this month, production for the month of June was 700 tons by 40. 700 by 40. That gives us 28,000. Here we have 28,000. Then 24 plus 28 will give us 52,000. And production for this month is given as 600 tons by 40, and 600 by 40 will give us 24,000. Then this will be 24,000. Then closing will be 28,000. Then the month of June, we have, in June we had 700 opening. Therefore that will be 28,000. We've calculated that 28,000 in the month of June. And purchases in the month of June were 800. Therefore 800 times by 40. 800 by 40. That gives us 32,000. So now we have 32,000, and 32,000 plus 28,000. 28,000 plus 32 will give us 60,000. And our production for the month of June was 700, and 700 by 40 will give us 28,000. We have already done that, 28,000. then it will give us the closing of 32,000. Then opening of July will be 32,000. Opening of July will be 32,000. Then after purchases of July will give us 36,000. Why? Because July will be 900 times by 40. 900, we multiply this by 40, and this will give us 36,000. So we'll have 36,000 plus 32,000, which gives us 68,000 rands. And 68,000 less production, and production for the month of July was 800, and 800 times by 40 will give us 800 by 40 will give us 32,000. We've already done that. Therefore now after that it will give us the closing of 36,000 in July. 36,000 will be the closing in the month of July. Then August opening balance will be 36,000 again, because closing becomes opening. And production of August was how much? Production was 900, and we know that 900 by 40 will give us 36,000. That will be 36,000. Then it will give us total of 72,000. And then 72 less production for this month. And production for this month was how much? Production for August was 900. And 900 times by 40 will give us 36,000 again. 900 by 40 will give us 36,000. Then at the end the closing balance will be 36,000, which becomes an opening balance of 36,000. Then after 36,000, production or purchases for the month of September was 900 again. Therefore now 900 times by 40 will give us the same 36,000, and this will be 72,000 rands, 72,000 rands, and less 36,000 rands. Remember, 36,000 rands would have been production for the month of September. And production of September is 900. 900 by 40, we have seen that it is 36,000. Therefore, the closing will be 36,000 rands. So now this is what this budget was all about. So now we continue in the same note. Now we do the next budget. And the next budget that was required was a budget for trade payables. The budget was 4.2.3 trade payables budget. So now we are doing a budget for our creditors, trade payables budget, which is 4.2.3 trade payables budget. So now we are doing trade payables budget, where we are budgeting for the payables, trade payables budget. Remember now, trade payables budget, we are looking at how are we going to pay our creditors and how much will be the balance of our trade payables by the end of each month, so that will be recorded in the statement of financial position by the end of each month or by the end of the year when it's for the year. So now in this case we have to take into account the raw material budget. Why? Because we are told that raw material is bought on credit. So now our trade payables budget will be connected with the raw material budget, which is the one which is in financial terms. Why? Because this is the material that is expected or will be bought on credit each and every month. And here are our purchases. These are the purchases that are expected to take place each and every month and in terms of material. And remember, all these purchases are done on credit. So now if they are done on credit, we need to know how will the payment take place. Therefore now that will tell us at the end of the day the trade payables budget. So now we were also informed that our suppliers are being paid 1 month after the month of purchase. Hence it said there that purchases of raw material, it says raw material. So now they are referring to the budget that we have just done. purchases of raw material will be on 1 month credit. That means we buy this month and we pay in the following month. So now that is what we'll be recording. We have to record the purchases and record the payments in this budget. So now we know that we are making a payment 1 month after the month of purchase with regard to the raw material that we buy on credit. So now this budget, it is still again for 6 months, starting in the month of April. We're recording April, we're recording May, we're recording June, we're recording July, we're recording August, and we're recording September. This is again for 6 months. And now we have to start with the opening balance always. And we did not owe our creditors any amount of money by the beginning of the period. So now that is why with regard to the opening balance, there will be nothing. But there was definitely a purchase of raw material in the month of April. And that purchase will be recorded under purchases, because we did buy from our suppliers during the month of April. And our purchases, this budget is opening balance plus purchases. Then after we say payments, and this is cash payments. Take that into account, cash payments. Then after this will bring us to the closing balance. Closing balance at the end. So now in the month of April, there were purchases of 44,000. Purchases of 44,000. I only recorded 44 without the another 0, 44,000. Purchases of 44,000. So now these were the purchases of 44,000. And not that one. These were the purchases of 44,000. So now here is under purchases. 44,000 was bought in April. So now we record that as purchases under the trade payables. So now we record only that amount as our purchases, as it is 44,000. And in May we had purchases of 28,000. In June we had purchases of 32,000. In July we had purchases of 36,000. In August we had purchases of 36,000. And in September we had purchases of 36,000. So now we have recorded all the purchases for their respective months. So now if this is done, then this budget becomes very, very easy. Remember, in April there was no opening balance because there was no purchase from the previous month. So now remember, the policy of the company say that all the raw material is bought on credit, in 1 month credit, in other words. So now they said purchases of raw material will be on 1 month credit, indicating that we purchased this month and the payment will take place in the following month. So now it means that there will be no cash payments in this month because we pay 1 month after the month of purchase. So now we draw a line here. Then we say this will be 44,000. No payments, then this becomes a closing balance of 44,000. So now that is the closing balance of the trade payables by the end of the month of April. So now if that is the closing balance, then it has to become an opening balance in the next month. So now this will have to be an opening balance for the next month. Therefore now closing becomes opening balance of 44,000 in the next month. Then we say now, okay, closing of 44,000 plus purchase of the month of May will give us 72,000 rands as the amount of our trade payables before the payment took place in the month of May. Then I will say in the month of May, there's supposed to definitely be a payment. There's supposed to definitely be a payment. Remember, whatever was bought in the month of April will be paid in the month of May. So now the purchase of the month of April becomes the payment of the month of May. So now that 44,000 will be paid 1 month later, which is in the following month. And the purchases of the month of May will be paid in the month of June. So therefore now 28,000 will be the payment in the month of June. And purchases in the month of June will be paid in the month of July. Therefore, now 32,000 will be a payment in the month of July. Purchases in the month of July will be paid in the month of August. Therefore, 36,000 will be payment in August, and purchases in the month of August will be paid in the following month or 1 month later. Therefore, now 36,000 rands will be paid in the month of September. So now, this is another very important part when it comes to this question that has been emphasized regarding the policy of the company in terms of how they pay their creditors. So now we have recorded all of that, and we have taken everything into account with regard to the payments. Therefore, now we say, okay, we have recorded all the payments in their respective months. Then after, now we have to record in the month of May now the closing balance, where we say 72 minus 44, then that will give us 28,000 rands. So now if this is 28,000 rands, the closing balance will become an opening balance in the next month, 28,000. Then we say 28,000 plus 32. 28,000 plus 32,000, that will give us 60,000 rands. Then 60,000 rands less 28,000, that will give us the closing balance of 32,000 rands. So now this will be the closing balance in the month of June. Then 32,000 rands becomes an opening balance once again. Opening balance, then we say opening balance plus purchases of 36,000, that will give us 68,000 rands. That will give us 68,000 rands. Then 68 less cash payments of 32,000 rands will give us 36,000 rands. And this is the closing in June. Closing in June becomes opening in August, 36,000 rands. Then 36,000 rands plus 36,000 rands of the purchases in the month of August, that will give us 72,000 rands as the total of the trade payables before the payment of the previous month took place. Therefore, now we less 36,000 rands, that will give us another 36,000 rands. Then after closing becomes opening, therefore now opening will be 36,000 rands plus purchases, then this will give us another 72,000 rands. We less 36,000 rands, and this will give us closing trade and other payables balance by the end of September. It will be 36,000 rands. So now this is how easy this budget is. A very easy budget to take into account, and very easy marks to just take. If you understand and you've analyzed the question very well, then all should go well. So now we do the budget before the last one, which is the trade receivables budget. The trade receivables budget, and the trade receivables budget is requirement 4.2.4. Trade receivables budget. This budget is linked with the sales. This budget is linked with sales. Why? Because we are selling to our customers. This is linked with sales, and this one is linked with the raw material. This was linked with raw material budget, with raw material, which is the one that is financial terms. Financial terms. Because we buy the raw material from the suppliers and we buy it on credit. Therefore, now hence it affects our trade payables. However, this budget will affect our sales. Why our sales? Is because we sell on credit from our customers. So now it will definitely affect the sales for each and every month. Our sales for each and every month, they are given here. We just have to say the selling price per unit, which is 100 rand, we multiply that by 100, multiply that by 100, multiply that by 100, multiply that by 100, multiply that by 100. We multiply everything by 100. So now, very easy budget to take into account. Very easy budget. So now that will mean our sales here will be 50,000 rands and 60,000 rands, 70,000 rands, 80,000 rands, 90,000 rands. So now, and another 90,000 rands. So now these will be our sales that will be recorded in their respective month. Very easy budget. Trade receivables budget is the budget before the last one. It is connected with the sales because we sell to our customers. Please also take into account the fact that it was noted that it is planned that sufficient inventory should be for each month available for the previous month. I want to see the part of the sales. Okay, this one. It says, and all sales will be made 1 month on credit. That means we sell this month and the customers will pay in the following month. That's what this means. So now we are doing the trade receivables budget. We are doing the trade receivables budget. So now we are doing this budget. 1, 2, 3, 4, 5, 6. There will still not be enough space. So now we are doing the sales receivables budget 4.2.4 trade receivables budget trade receivables budget. And in the trade receivables budget, we still do it for 6 months, starting in the month of April. We have April, we have the month of May, we have the month of June, we have the month of July, we have the month of August, and we have the month of September. And we have the month of September. We start with the opening balance. Opening balance, then we record the sales because we are selling in this case to our customers. Then we draw a line here. Then from here we will have cash received. Cash received from customers. When customers pay, then we'll receive that cash. And after cash received from customers, we'll have the closing balance. Then we'll have the closing balance. Then you can draw the lines there in between. Then after the closing balance, then this budget will be completely done. This budget will be completely done. So now there was no opening. Why no opening? Because there were no sales that took place before the month of April. So now sales started in the month of April. And I showed you in the month of May. Sorry. So now in April, there is nothing. Completely nothing. No opening balance and there is no sales. Sales started in the month of May. And I showed you that we have to multiply by 100. This will be 50,000. This will be 60,000. We get to 70,000. We get to 80,000. We get to 90,000 and 90,000. So now this will be the sales. Multiply everything by 100, by 100, by 100, by 100, by 100. So now our sales will be 50,000, 60, 70, 50,000, 60,000, 70,000, 80,000, and 90,000. So now we only have our sales starting in the month of May. In April, there was nothing. No cash received and closing was 0. Opening in May in terms of trade receivables, there was no opening. And our sales were 50,000. Therefore now total available will be 50,000 and closing will be 50,000. Therefore now remember, in the month in which sales takes place, there is no receipt of cash from customers. So customers, they don't pay in the same month. Therefore now that 50,000 becomes an opening balance. Therefore now the opening balance will be 50,000 in the month of June. Therefore now we say, okay, 50 plus 60,000 will give us 110,000. So now payment has to start now. Remember, with regard to the payment, we know that sales of this month will be paid in the next month. Therefore now the 50,000 will be paid here. Sales of the month of June will be paid in the month of July. So now cash will be received here. This will be negative. Therefore now it will be 60,000 rands that will be paid by customers. Sales of the month of July will be paid in the month of August. Therefore, now this will be 70,000 rands. And sales of the month of August will be paid in the next month because sales are made 1 month on credit. 80,000. Remember, the policy says sales are made 1 month on credit. So now we record that as it is. Sales of the previous month are paid in the following month. So now this will be the payments by our customers where they pay 1 month later, where our customers will pay 1 month later. So now we have recorded all of that. Then let us continue and recording all that is necessary. Then now we were in the month of June. We were in the month of June, and in the month of June we added the two and it gave us 110,000 less 50,000. That gives us 60,000 rands. Closing balance becomes an opening balance. 60,000 plus 70,000 will give us 130,000 rands, and 130,000 less 60,000 will be 70,000 rands. And 70,000 will be an opening balance in the month of August. And 70,000 plus 80,000 will be 150,000 rands. And 150 minus 70,000 will give us 80,000 rands. And 80,000 is the closing balance, and closing balance becomes an opening balance of the next month, 80,000 rands. And 80,000 plus 90,000 rands will give us 170,000 rands. And 170 plus 80,000 will give us 90,000 rands as the trade and other receivables budget or closing balance by the end of September, which will be recorded in the statement of financial position by the end of September. So now we have recorded this budget and we'll be doing the last budget. Very easy budget once again to take into account. So now we do the last budget, which is cash budget. 4.2.4. 4.2.4 or 0.5, not sure. 4.2.5, yes, cash budget. So now we are doing cash budget. This is cash budget, which is the last question. And our cash budget now will record only the cash items. We start in the month of April once again. It is for the 9 month, April, May, June, July, August, and September. We record the inflows of cash. With regard to the inflow of cash, now we have to record all the cash that we knew that it came into the business. So now when it comes to inflow of cash or receipts, in other words, remember there was shares that were issued, and the shares amounted to 300,000, and it was cash issue of shares. So that will be cash inflow, and I did record that. So now we will record that as shares issue, share issue. So that will be share issue, and share issue will be recorded as an amount of 300,000 rands. It will be 300,000 rands. And there was no other issue of shares until further notice. Then now we had cash that was received from debtors. Let me just say debtors collection. From debtors, we receive money, I think, starting in the month of June. With regard to debtors, we only received money starting in the month of June, because there was no cash received in April. There was no cash received in April. There was nothing. In May, there was nothing. We started receiving 50, 60, 70, 80 in June, July, August, September. So I'll be recording 50,000, 60,000, 70,000, and 80,000. So now we are recording that in the month of June, which is 50,000, in June, 60,000 in July, 17,000 in August, and 80,000 in September. So now these are the inflows of cash that came into the business in the respective months. So now we can calculate the total of everything for only the inflows, because these are the only inflows that were expected in the respective months. So now it will be 300,000 here, and there will be no inflow of cash in the month of May. Then it will be 50,000 and 60,000, and it will be 70,000 and 80,000. This will be the expected inflows of cash in their respective month. Then after we record outflow. Then under outflow now we had payments of trade payables. We had payments of trade payables. So now we can record that as payments, and it's payments of trade payables. Please take note of the fact that I don't have enough space. Payments of trade payables. Then now we have to go to our trade payables budget. In our trade payables budget, we recorded payments for each and every month, and the payments started in the month of May. And here were the payments. We paid our trade payables, or we paid our suppliers 44,000, 28,000, 32,000, 36,000, and 36,000 from the month of May until the month of September. So now this is what we will be recording in this part now. So now let me record that so that we see what is exactly happening. So now we go and we record the outflow of cash, starting with the payments to our suppliers. Payments of creditors. Payments of creditors. And we started paying our creditors. Let us check that. We started paying our creditors. Just want to make sure that we have it on the same page. Our creditors were paid from the month of May, which is 44,000. May, we have to record 44,000 of the payment. Then after, there was a payment of 28,000 in the month of June. 28,000. There was a payment of 32,000 in the month of July. Payment of 32,000 in the month of July. There was a payment of 36,000 and 36,000 in August and September. So we record 36,000 in August and 36,000 in September. So now these payments we have accounted for that. Then I can delete that. Then now we record other expenses that were accounted for. I think there was also labor cost that was incurred. There was labor cost which was based on the finished products. And they told us that labor cost is 20 Rand per unit of a product finished. And they told us that the direct labor cost which will be available, well, which varies with the level of production, is planned at 20 Rand a unit of a finished product. So now we need to go to our finished units. Then that means we have to go to our production budget. To our finished goods budget. The first budget we dealt with. And that first budget at production units, 500. Here is the budget we are talking about. We had a budget where we had to account for the units that were finished. There, the production budget. So now this is the budget that we are dealing with now. So now in this budget, we have to multiply every unit that was produced under production by 20. Then that will give us the direct labor cost that was paid in the respective months. So now in other words, our labor will be 500 times by 20, this 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 times by 20. So now that's what we'll be doing in this budget. Therefore now we will do the same thing throughout. Then we record that in the cash budget as labor cost. So now first of all, it will be 500 by 20 by 20. It will give us 10,000 in the month of April. Why in April? Because there was production in April. Then in June we say 600, or sorry, May times by 20, that will be 12,000. Then we say 700 by 20, that will give us 14,000. Then after we will have 800, that by 20 it will be 16,000. Then the one before the last, it will be 900 by 20, that will give us 18,000. Then the last one will be 18,000 because it was again 900 units. Then our labor is done. Then after we have to do overheads. We had overheads. Our overheads, we had those that were production related. Production overheads. Our production overheads, it was very easy. We just had to say 20,000 less 3,000 because our production overheads amounted to 20,000, but they included a non-cash item which is depreciation. So now it will be 20,000 rands less 3,000 of depreciation. Therefore that will give us 17,000 throughout the months up to the end of September. So now our production overheads will be 17,000 throughout until the last month. Therefore now we record 17,000 rands. 17,000 rands. We record 17,000 rands. We record 17,000 rands. 17,000 rands. And we record 17,000 rands. Then now we record the non-production overheads. Production overheads, we record the non-production. Non-production overheads will be, as it is given here, that it was 11,000 and there was 1,000 of depreciation, which is a non-cash item. And the same thing will happen. They said non-production overheads is 11,000 and there is 1,000 of the depreciation. Therefore, it will be 11,000 less 1,000. Then this will give us 10,000 of the non-production overheads for the rest of the months. So now we record 10,000 throughout. So now it will be 10,000 until the end. We record 10,000 of the non-production overheads. 10,000. And we record 10,000. And we record 10,000. And we record 10,000, and we record 10,000 once again. So now we have recorded most of what was needed in this question, but there's still one thing left. One thing that is left was the non-fixed asset of 250,000 that was bought in the month of April. And they said you must assume that all payments will take place in the same month as the cost was incurred, indicating that the 200,000 of the payment of the non-current asset will have to take place in the same month of April. So now this will be fixed asset. I'll just say fixed asset. Just for space purpose, fixed asset of 250,000 rands. So now from here, I have recorded everything that was needed for this exercise. So now I am just calculating all the totals, and when I'm done with all the totals, then now we'll be able to complete our cash budget. We'll be able to complete our cash budget. So now from here, there will be nothing. So now I can draw a line here. Then after I will have surplus or deficit. Surplus/deficit. So let me calculate now the total for the month of April in terms of the outflow. Then for the second column, for the third column, here we have the month of April, May, June, July, August, and September. So now we calculate that. Then let me give the total of everything first. So now we are in the month of April. Under the outflows, we have labor of 10,000 plus 17,000 plus 10,000 plus 250,000. This gives us 287,000 as the outflow in the month of April. 287,000. 287,000. That is outflow of cash, and this is in brackets. Then after we go to the second month, we say 44,000 plus 12,000 plus 17,000 plus 10,000, and this will be 83,000. And we record that 83,000. We record that 83,000. Then now we record the second month or the third month, where we say 28,000 plus 14,000 plus 17,000 plus 10,000, and this gives us 69,000. And this will be 69,000. Then we do the same thing for the last one. We record the first one, which is 32,000. 32,000 plus 16,000 plus 17,000 plus 10,000. So now that will be 75,000, and we record that as 75,000. Then from 75,000 we again continue to the one before the last. Then we say 36,000 plus 18,000 plus 17,000 plus 10,000. That gives us 81,000. Then from 81,000 we do the last one, 36,000 plus 18,000 plus 17,000 plus 10,000. This should be the same as 81,000. I should have just recorded that as it is. So now we have 81,000, then everything is complete and is done. Then the last part will be the balance brought forward. Balance carry forward. So now we'll be recording now up to the balance, and we'll be done with our cash budget. So now let us take it from that note and we complete it. So now there was no opening balance in this exercise. So now we just say the inflows that we have, and our inflow is 300,000 in the first month. 300,000 minus 287,000. 287,000. Then that will give us 13,000. And we record 13,000 as the difference. We record 13,000 as the difference. There we'll have 13,000 and it's positive. And that 13,000 becomes the balance carry forward 13,000. Then after we say our inflows for the next month, which is the month of May, there is no inflow. Therefore now 83,000 becomes negative as brought forward. Then we say 83,000 negative, because there was no inflows of cash. Therefore now 83,000 plus, or in fact 83 plus 13,000, it will be 83,000 minus 13,000. This will give us 70,000 negative. This will be 70,000 negative. Then now we continue to the next column, which is the month of June. In the month of June, there was inflow of 50,000 and there was outflow of 69,000. Then that brings us to a negative 19,000 balance or difference, 19,000. Then we say 19,000 plus the balance that was carried forward. Then it will be negative 70,000 because these amounts are both negative. Then this will give us negative balance of 89,000. So now that will be 89,000 negative. Then we go to the next month, which is June. We have inflow of 60,000 rands and we less 75,000 rands, and this will give us 15,000 rands difference, which is a deficit. 15,000 rands negative. Then we add that to the balance that was brought forward. Then we say less 89,000. That gave us more negative balance as 104,000 negative balance. Then now we go to the next month, and the next month is the month of August. In the month of August, we say inflow of cash of 70,000 less the outflow of cash of 81,000, and this gives us 11,000 of a deficit, and we record that 11,000 as a deficit. Therefore, now we say 11,000 less 104,000. That means we are adding that to the 104,000 because it was a balance negative previous month or carried forward. Then now we go to the next month again, which is the last month. The inflow of cash in September was 80,000. Then I will say 80,000 less the outflow of cash of 81,000. That gives us negative deficit again of 1,000. Therefore, now we say 1,000, we add 115,000, then that will give us 116,000 as a very negative balance in the bank. So now there was really too much outflow of cash here, more than the inflows of cash. So now with that being said, we have covered all the requirements that were required to be done in this exercise. And with that being said, I think guys, I've made everything simpler and try to simplify, and I hope you will enjoy this video and you'll have understood something at the end of this video. So now with that being said, thank you on my side. Hope you'll enjoy the video.